Good day, fellow investors. Today I want to discuss the difficulties but also the benefits of value investing and use Warren Buffett as an example, especially his Apple situation. So, you probably know that over the last few quarters, Warren Buffett sold 50% of his Apple shares and even more, reaching the highest ever cash position on his balance sheet. And he has been selling Apple the last few quarters, and especially in the last quarter, with 389 million shares sold at the average estimated closing price of 186. Also, through the earlier quarters, 185. However, keep in mind that if we look at Apple stock from when Warren Buffett was selling to where it is now, Warren Buffett could have waited and made even more money or had more of valuable Apple stock now within his portfolio. And because he didn't wait, he lost at least $20 billion, and $20 billion is also a lot of money for Warren Buffett. And here I really want to discuss the difficulties Warren Buffett is having of being a value investor. Because here, if you sell here, yes, you lose this, and then everyone will be saying what an idiot Warren Buffett was, because the stock can easily go even higher and higher. But let's take a look at Apple and why Warren Buffett sold. Here you have the first clue on why he sold. Price-earnings ratio of 44, dividend yield of 0.44%. And if you look at Apple and the revenues there, pretty much stagnant lately, net income pretty much stagnant, and therefore when you compare that with a price-earnings ratio of 44, you understand that Warren Buffett has been feeling nervous about this, and especially on the buybacks. I'm sure that he didn't like it that Apple spent $100 billion per year over the last few years on buybacks, because he always says in his letters that buybacks are smart if done at the right price. If Buffett is selling, then also all these buybacks Apple has been doing and is still doing are not smart because not at the right price. But let's take a look at Apple. We have a business that's making around 100 billion per year, stable. Buybacks push the stock higher, that's a given. And then we have great products, great ecosystem. I'm filming this on an iPhone, iMac, iMovie, editing, whatever. So it is there, it has its place in the market, and will likely continue to have that place in the market. However, there is also the negatives of an investment. The P ratio 45, new products, what will be the next growth generator, which is a risk, competition, recession, less purchasing. So are these top maximum Apple earnings? Anything can happen. They can hit a new product, but that's risky. That's not value investing. And the key is here, when it comes to investing, what is the risk and reward of investing? With a P ratio of 34, if it goes to a P ratio of 17, don't forget Warren was buying Apple when the P ratio was 10. If it goes back to a P ratio of 17, we go to 110, which is not far from where the stock was just a year and a half ago. A year and a half ago. People think now it's impossible that Apple halves in value, but that is the risk and reward. And yes, Buffett lost 20 billion, but if the stock would revert to normal valuation on just a slowdown or recession, whatever, Buffett would lose 150 billion, and that's something he is not willing to do. So those are always the situations with value investing. You hold, you hold, you hold, but at some point, because of the risk and reward changing, you sell. And what did Warren Buffett exchange Apple for? He exchanged it for pure certainty, 5% yield on treasuries, and he will be getting 5 billion on his 100 billion or 200 that he sold, 10 billion no matter what. So the key question with value investing is, can I lose with Apple stock now? Warren Buffett said, yes, you can. And then we can go further, but this is not value investing anymore? How much can I gain? Which is the question most people are asking themselves, but this is value investing. Can I lose with Apple stock now? Yes, you can lose for a very, very long time. Can I lose with treasuries? It's very hard to lose with treasuries. And I know it's very hard, extremely hard to be a value investor now, especially given what's going on in the market, because stocks over the last 5 years are going just up, and we had one little situation here for a week, begin August, and now stocks are going again up and up. But if we look at fundamentals, we know as value investors we can miss the upside, because if this yield returns to the normal historical yield, that's minus 70% for the S&P 500. Will that happen? I don't know, but as a value investor, I'm focused on risk, and I don't want to hold that risk. That's it. So we are boring, we wait, we take that 5% here and there compared to 100% that people made on Apple over the last year and a half, but that's not value investing. And the key thing with value investing is that it works always. All other kinds of investing work until they don't. Think about it. Thanks for watching. I'll see you in the next video.